you can see the Nikkei flashing for you. The problem with the markets is actually twofold and both are actually contrary. With respect to China, it's a growth scare, and with respect to the US, after the Jackson Hole interview with Stanley Fischer, September remains alive as a potential rate hiking FOMC meeting. Now that double dose makes emerging markets the most unloved class. In the first place, China is not growing, so emerging markets as a category trade with China. There will be small exceptions like India, which would be a beneficiary when commodities fall and which is not a big trading partner. But for the rest of the world, either you are selling commodities and therefore you're taking a beating, the emerging markets, or you are trading with China. China is consuming less, and Sonia would know about the JLRs that it is buying less, and therefore those countries get hit. So EM as a class is an unloved class. And then you have this big problem or scare, if you please, that the FOMC could hike rates. There is probably a less than 50% chance, but that is very much there. And that again would mean a certain doubt as to how will the currencies move. Last time around, when the taper talk was first started, we knew what a run the Asian currencies suffered. Now it's more a fear of the unknown. There will probably be some winners and some men among the boys. But as a class, why would an investor buy emerging market shares ahead of September 17? I fail to understand. So I think that's what we are going to live through over the next 2 weeks.
Oh yes, absolutely. And I think global cues will dominate today as well. I'm sure everyone is glad that August is out of the way, because for the US markets, it was one of the worst months we've seen since 2010. I mean, the Dow is down 6.5% in the month of August. And, even overnight, we've seen a big crack in the Dow, as you can see. But even for our own markets, there was a fresh onslaught of selling by FIIs yesterday. So that will worry a lot of people on the street. I mean, 550 crores of selling in the cash market, and in a lot of heavyweights there was delivery-based selling. So whether it was Reliance and HDFC, there was about 300 crores of delivery-based selling seen in those names. And in names like ICICI Bank, etc., there was quite a bit of delivery-based selling of 250 crores or so. Interestingly, on the flip side, there was massive buying seen in Sun Pharma, almost 950 crores of delivery-based buying. So the market has its favorites. If you can see that bar graph, I mean, there's a sudden spike in the delivery volumes over there. Market has its favorites, and the market will continue to stick to quality. But Anuj, morning, we were talking about this, how the two-day move on Thursday and Friday would have been short-lived, and it was. You expect the market to resume its downtrend now?
Morning, Sonia. Morning, Lata. One thing, in market or in life, everyone is entitled to opinions, but you're not entitled to facts. Facts are facts. and the fact is that right now, equity markets are going through a treacherous period, and you have to just be on the sidelines. Look, yesterday who would have made money? Hand on heart, no Nifty trader would have made money.
I doubt anybody.
You would have been chopped out both sides. You would have been stopped out both sides. You can say that, okay, if you would have taken short position yesterday, this morning you would have made a lot of money, but then that's, might as well go into casino. I mean, you might as well taken a gambling. What if the Dow was up 300 points overnight? Today the start would have been at 80.50 instead of 78.50. So look, right now you are in a period in which the best position is cash. You need to wait on the sidelines, let the prices come to you, then go out and buy. If they fall more, have some more capital, have some capital preservation and buy.
For an investor, Anuj, what's the problem for a trade? I mean, for the trader, is there a trading day?
Exactly, that's what I'm saying. For right now, it's no trade zone. Unless and until, you are, and there are really smart traders who, gauge 30, 40, 50 point moves very smartly. More power to them. You can go out and do it. But then, you should be prepared for losses as well. My point right now is that, we have to analyze trade every day at 8 a.m. because that's our job, right? But at the end of the day, most money in this market is made by not doing anything in times like these, staying on the sidelines. I'll just give you one example. When did you make most money in this market recently? Post 2008, when the whole crisis was over. But who made that money? Someone who sat through 2008, not doing anything and preserving capital. Preserving capital is the most important part. Preserving cash is the most important part. Right now, I think the best position is cash. I mean, you can analyze the FI number, the DI number, the delivery-based data, but the fact is that, these are all technicals. They keep changing. The only technical point which would worry me is the F&O data from FIIs. Yes, there's been index futures buying. There was 500 crores of index futures buying yesterday, and there was index long build-ups. That's indicating that, yes, there's been some buying as well at lower levels, but the way puts are being bought, yesterday 5 puts were bought for every 1 index call, and FIs bought about 1400 crores in index options. And as I pointed out yesterday, Sonia, the unusually high premium at 7200 and 7300 puts is telling you that there's a bit of a fear in the market. And for all the best time to buy at times is during the fear period, but the kind of fall that can happen during this period can be really damaging to your capital. I would be watching out for the 7800 mark first. That was the closing bottom for the market, and the 7700 to 7800 zone as the important support zone for the market. Because if the Dow is going to 15,000, as a lot of people believe it is, in that case, in the near term, you're not going to decouple. In the medium term, you will decouple, but in the near term, you will not. So right now, it's so volatile. You need to go through a period of boring 5 or 6 days for US markets. This whole 200-point up day, 300-point down day is not going to take you anywhere. And in this market, if you trade, you should be aware that, while you can make a lot of money, you can equally lose a lot of money as well. So my only submission is that this is the time to actually preserve cash. Opportunities will come.
Indeed, and we are getting a lot of negative cues this morning. Added to that list is how tepid the domestic growth has been. Lata, you've been saying how, this is lag data, so the market may not have take too much store to it. But what was the fine print of the data that would disappoint the street?
Well, for me, there are the tepidness of the data is actually in the government spending. The government spending is seen in a category called public administration, health and education services. That's grown by 2.8%. It's the worst in the entire category. And that grows over 2.7% last year. So there's no complaint of a high base as well. So government spending simply is not enough. We may say that it's more than in previous years or, whatever, but it's not showing in terms of quantum. And the second place where the government failure is very evident, the only number slightly higher than this 2.8% is electricity 3%. Last year it was 10%. Now what is the logic? It's just that discoms are not buying. So clearly what the GDP data is screaming out and telling you is that the government is not doing enough. The whole logic of this growth story in India is that government will pump prime. Government is spending on roads and railways, and someday that's going to bring light at the end of the tunnel. Yes. It's not there in the GDP numbers, and that's quite negative. The other negative, again, from a public finance point of view, is the nominal numbers. What you talk about real GVA is adjusting it to 2010-11 prices. If you don't adjust it to 2010-11 prices, if you count all your cars and shirts and trousers and saris in current prices, you get a nominal GDP of 8.8%. Now, when you count the fiscal deficit, you count it on current, the fiscal deficit is 3.9% of current GDP. Yeah. There, the estimate is 11.5%. So your estimate of fiscal deficit at 3.9 will work, provided your nominal GDP grows at 11.5. If it's growing at 8.8, you're either going to default on your fiscal deficit target, or you have to cut expenditure even more. And that seems to be the problem, that government pump priming is not there. So there is that, the government part of the argument has to go out of our minds, that this economy will be pump primed by the government.
That's not happening yet.
Argument is getting shot at all levels. Though, of course, the fiscal numbers also came yesterday, and they indicated that the government's expenditure has gone up to about 34% of the full year's expenditure, which is very good. They have spent 4 months, which is 1/3 of the year. The government has spent 1/3 of the expenditure budget, which is very good. But the point is that's not enough. It's not showing up in the form of growth. And that's a very important takeaway from the numbers. And then, of course, we had core sector also, which was bad. The bright spot in yesterday's news was HDFC Bank cut rates by 35 basis points. Yes. That is equal to the total base rate cut in all these months from January, since the rate cuts began. That's positive. Finally, the transmission is happening. I don't see anybody who is lending auto loans, and those are the loans that people are really giving. Who's giving loans to corporates? So auto loans and home loans, you just have to compete with HDFC Bank. If one bank is giving you at 9.3, why on earth will you take an ICICI loan? Why on earth will you take an SBI loan? And HDFC Bank is known for its speed of service as well. So, there's no way on earth ICICI can stay at 9.7 when HDFC is...
So base rates will now trend lower for the entire industry.
It's going to be margin problems for banks maybe for the time being. Eventually the deposit rates will come down.
But at least
for
demand
the system as a whole, it's good because this is how things have to move. This transmission is the word we've been hearing from the RBI for the last 9 months. That's finally happened. So today, autos and real estate will celebrate. Banks will be a little glum. But overall for the economy, that is the only positive that happened yesterday.
Also NBFCs, all the NBFCs will celebrate today, right? All right, well, we'll talk about all that and more through the course of the show, but here's what you'll get to see on the show this morning. Ramdev Agarwal, Rajat Rajkaria and Naveen Agarwal will join in for an exclusive curtain raiser to the Motilal Oswal 11th Annual Global Investor Conference. That will be between September 7th and September 11th. So we'll talk to them about all cues, micro and macro. Indranil Sengupta, Chief India Economist at Bank of America Merrill Lynch, and HSBC's Chief India Economist Pranjal Bhandari will join in to fine-tune the Q1 GDP numbers for us. Vivek Gambhir, the Managing Director at Godrej Consumer Products, will join in to discuss their product strategy and whether there is any improvement in the rural sales. That's an important topic that we're going to discuss on the show as well. But first up, in all likelihood, the markets